Okay, chapter 5. So the issue here, again, like your non-current, I mean, if these are assets, these are just intangible ones. And we're really just asking the question, how do we deal with the recognition of intangible assets? When do we recognize? Because as you can imagine, when you buy these assets, for example, you're going to go debit, right? Debit asset, credit, bank, or whatever. I mean, an asset is capital expenditure. It's still an expense, but it's just capital. The argument is that when can we recognize something as an asset? I mean, with our buildings and our with finished capital products, we just buy them and we know that that's what they are, and then we can then start depreciating them, right? But with one second, sorry. With finished buildings, we can do that. We can buy the asset. We know what's going on. But imagine you're actually either producing or making this product, and you've spent so much money, if you like, on building this thing. So you have to debit something. The question is what you really want to try and do, depending on what it is. Most people want to recognize this cost as asset as opposed to expense, because if you recognize this cost as an expense, it hits your profit straight away. At least if you recognize it as asset, you're able to depreciate it and regulate the cost over a number of years. This way, this is what you're ultimately trying to arrive at, and you're trying to kind of reduce. You don't want to do debit, expense, credit, bank. Unless you don't want to do that. Most people want to debit, asset, credit, bank. I mean, the process of depreciation is still going to transfer some of this to the profit and loss via depreciation or amortization, as we're going to come to see. But ultimately, that's what you're trying to avoid. So, what are we saying here? This IAS kind of guides us as to when to recognize intangible assets as assets. Otherwise, we would have to recognize them as expenses. So it gives us the definition, the requirements when we can recognize. It's all about recognition, isn't it? And then how we treat that, and the disclosures, what we have to say, if you like, in the notes of the accounts. What is an intangible asset? So an intangible asset is an identifiable, we can clearly see it, we know what's going on, it's non-monetary, we can't touch it without physical substance. So like we were saying earlier on, so maybe a piece of paper, that's a patent, that gives you the right, if you like, to make a drug for a certain number of years without anyone interfering, a brand, so to speak, and we know what's going on with the brand. We can see revenue being generated as a result of this brand or this logo, something. So you can see that it's not a building or anything like that, or a machine, but it's still an asset that is bringing in economic inflow. Right, and you can see why the definition of asset starts to change from this idea of something you own. It's very much about, if you like, something that will bring in. Remember, the definition was talking about a past transaction and economic inflow kind of flowing in as a result of that initial transaction. So, in terms of recognition, in terms of even recognizing most assets, you must be able to identify it. So clearly separated from other assets. So you must be able to almost sell it on its own, if you like. It's not really a part of other assets. It's on its own. Almost like that license can be sold separately from the rest of any other asset. So that's the first thing. You control it. You can do what you want to do with it. It's reliable, so there's a market. Reliability really comes to do with the fact that there's a market for it, and we have people who can come in and say to us, yes, that's what it actually costs. So there's a market. A market is a good sign that whatever the value where we're asserting it is reliable, that it will bring in future economic benefit. This you can see here, this applies to every other asset. And we don't normally recognize internally generated assets. Right, so typically, like all assets, we always recognize assets initially at cost. And then, of course, because this just means depreciate, but again, you may choose not to depreciate. You may choose to. It says here, if you can depreciate if there is reliable estimate of estimated useful life. But the thing about intangibles is that you can't quite say that. With brands, you don't quite know how long it's going to live. It's not like a machine. So because of that, you almost need to kind of do something, but make sure you look at what's going on every year and check to see if it's falling in value or if it's devalued. We'll see impairment in the next chapter. So we because you see, we want to be prudent. We want to make sure that the value of that asset is the right amount once we've recognized it. And if we don't know what the UEL is, we have to almost, if you like, revalue it or amortize it, and then annually check for annual impairment to see if it's actually falling in value every year. Again, we talked about future economic benefit, and like I said, you can revalue intangibles, but there needs to be an active market for identical assets, and that's very difficult, isn't it? So if you have a brand, that's just your brand. So how do we regularly revalue that? All we're doing is just looking for its value, its own value, and checking if it's still worth what it is via carrying out this annual impairment review. Now, this is what I was talking about here. So let's just go to the drug industry, right? So now the drug industry, of course, you can see that you have people in labs who are working and spending time on research and development and trying to find, if you like, or trying to create and produce new drugs. Right, that's what they're trying to do, create new drugs. So they're spending time and money. The question is, if they're spending time and money trying to make these new drugs, at what point do they classify that money they're spending as asset, and when is it just an expense, if you like? And that's kind of the difficulty we have. We know credit is bank. The question is, what is debit, asset, or expense? And we have some guidance. And the guidance is that if it is under the heading of research, if you like, so just the original investigation undertaken to obtain new knowledge, it's just an expense, right? It's just an expense. It only starts to qualify for asset status, if you like, when it hits the, if you like, development stage. So the question of development here, look at this definition. This is the application of research findings to produce new and improved materials, capitalize, and, well, of course, amortize if meeting specific criteria. So there's still some things to meet, still some criteria, but it must have hit this point of what we call development. So research is, we're just spending money trying to understand, investigate, and see what's going on. And typically you'll have experts who will be able to help you to say, yeah, we're just spending money investigating. Suddenly we've found something, and then we can start saying we're making something new or improved. And what are the conditions? So there's a nice mnemonic here called sector. So first of all, I think the conditions are kind of back and forth. When I say back and forth, this isn't actually even to do with the product itself, but the fact that you need enough funds to be able to complete the product is a condition. And the fact that you will complete the development. And I think probably this is the one I always used to remember first, that it's technically feasible. So there is evidence that this thing could actually start working, or it can be completed. It's starting to make sense. It's reached a point where, like, yes, this thing can actually go forward and become a drug. Right? That's kind of the key issue here. But really, you can see it's about being able to complete the project, overall profitable, and someone or a body can reliably measure it. Now, of course, this is level 4, so they'll always very clearly tell you, give you this hint as to whether or not that this is possible. And if you can tick all these boxes, or tick whatever the number of boxes you do, then it becomes development, and then that means you can definitely capitalize it. It becomes A. If you can't do any of these, it's just E. So debit E, credit bank, or whatever it is that you're crediting, if it's a trust, whatever the liability is. But I don't think that you're bothered about the credit side. It's more the expense side that people are interested in. And again, this is similar to depreciation, nothing different, just because we don't have this sort of, we have an EUL, but we call this amortization, same idea. And if there is no, so if you're not going to have an estimated useful life every year, you should carry out an annual impairment review to see if it's falling in value. Okay, great. So let's do the example in the workbook very quickly. and just to see what they're saying here. You want to be very careful with these because it's really about dates and periods in the year. So what you're always watching out for is not the actual knowledge, it's just watch out the dates. So look at this question. Salmon Limited, a manufacturer of food packaging, has undertaken a number of research and development activities. It can be assumed that the expenditure occurs evenly over the year. So here it says that 500,000 has been spent testing a new type of plastic to see if it is harmful. So this 500,000 has been spent testing. This is just investigation, right? They're just testing it. They're testing. They're still testing. They wait to see the results, wait to see what's really going on, but they're still testing. And because they're just testing, this is all research. And therefore all of this is just expensed. So you pretty much just have debit expense, as in the income statement, credit bank, however they're paying, with 500,000. No questions asked. Let's look at this one. It says in the prior year, Salmon performed tests on a new type of plastic and found that it decomposes. And so that we're beginning to see results much more quickly than the traditional plastics. During the year, 120 had been spent. Okay, so January to December, 120 had been spent. And it says on the 1st of August, the directors received the results of the market research that demonstrated a massive demand for this new bottle, and they have sufficient funds to bring it to market. So it was only until the 1st of August that this thing became viable, right? Became technically feasible. It can happen. There's a market for it. And so that means with August, that leaves you with August, September, October, November, December. So it's 5 months of this. 5 months of this cost can be considered asset, right? Because now it's viable. Prior to that, 7 months of this, if you like, is all expense, right? So I would do 5 over 12 times 120,000. Oh, that's a nice one. So you have 50,000 here. So this 50,000, if you like, we can go debit asset, credit bank. For the 70,000, we have to go debit expense, credit bank. And that's how we deal with it. So that's what you're always watching out for. You're watching out for the dates. You're watching out for what I said earlier on about this question of sector, to see if you want to make sure that you have enough. You want to make sure that this thing can actually carry on to becoming a viable product. Okay, great stuff. So I think that's good. So we'll this is the first part. There's a second part to this, just some calculation with amortization, but we'll call this part 1 so you have something on the break. Okay, thank you.